5-month-long correction that has shaved between 15% to 25% of the key indices here in India, and it has led to deeper cuts in the mid and small cap universe. For many Indian investors who are used to extremely shallow corrections since COVID, such a prolonged period of Indian underperformance has really been a bit of a bolt from the blue. Over the last 1 week, the selling has abated to an extent, but then sentiment as well as recovery are still very, very fragile, Nigel.
Well, that's right. The Nifty has recovered close to around 2 to around 3% from the recent lows with regard to that correction, but it's still 14% away from the peak. The problem is the mid and the small cap indices, they are still nursing steep losses, which are in excess of around 20 to around 22% odd. The market is now showing some signs of returning to form as valuations, well, they're a little bit more palatable. Crude and the dollar as well have cooled off, which is a tailwind from an India market perspective.
So the question is, that's the question we are going to ask to our big special guest on the show today, is the worst over? Are we finally seeing light at the end of the tunnel? Hello and welcome to this very special conversation, Market Editor. Today we have with us one of the biggest bulls on the India story, Morgan Stanley's India Equity Strategist, Ridham Desai. Now, as we start this conversation, we must tell our viewers that Ridham feels that Indian fundamentals are actually improving. It's not that bad out there. And he feels that the markets could be at a turning point in this, time of 2025. Ridham, it's such a pleasure to have you with us in person in the studios. You know, any morning is a great morning to talk to you. This one is even special because look at the backdrop. We have so much masala to go over. Thank you so much for joining in.
My pleasure. Good to be back.
So let's actually start right there. Right? So much pessimism. 5 months of a correction. This is a market that was about 3% correction. Ko correction bolte hain pe. That's what happened, right? After the COVID rally. Now where we stand, there was this whole talk of US exceptionalism. That's my first question to you. So we were upset over the last several months because of US exceptionalism. Money was going to the home market. Now, last 2-3 days, it's become very apparent that exceptionalism is being questioned. So does that feed in further into your narrative, which is anyway very positive on India?
So I think India put a peak at the end of September last year. And the genesis, the idiosyncratic genesis of the peak, so leave aside what has happened in the world, which is a lot, and it's very complicated, was the fact that India's growth was slowing down. And this growth slowdown, in my view, was triggered by policy tightening. The fiscal deficit was compressed in the trailing 12 months by about 120 basis points, from 6 to 4.8. We're still finishing that financial year. And a lot of that compression happened in the first 6 months of the year, due to very specific factors like elections, heavy rains in August, Shraddh getting advanced, etc. And it got compounded because the RBI was also, I think, quite stringent with its policies. And leave aside rates, liquidity was tight, and the regulatory overburden on the banking sector had gone up. So we arrived in the last quarter of last calendar with credit growth slowing from a peak of 16 to under 11, and government spending really slow. So the quarter produced bad earnings and stock prices took it on the chin. Now at the same time, something I underestimated in terms of its importance was that China inflected in terms of policy. And this 27 September is the day after China's fiscal policy changed. And a lot of commentators said that, oh no, this fiscal stimulus is investment oriented, China needs consumption, but it marked the bottom on the Chinese markets. At a time when India was constraining its fiscal and monetary policy, China was actually getting more dovish. And we've had very steep underperformance, which is not visible in your headline numbers, between India and China. A complete reversal of what we had seen in 23 and 24. Yeah. So India is back to where it was in 23 relative to China. And India's growth rate is much better than China, even today, even with its slower growth rate. So the relative adjustment has been very sharp. Now what has happened is that we saw in February a policy pivot, which I will say is one of the biggest in my career, going back 35 years. The RBI has put a three-pronged correction, cutting interest rates, committing itself to liquidity, and also starting to lift the regulatory burden on the banking sector. The government's fiscal contraction continues, which is absolutely what they need to do, because you have to prepare the government's balance sheet for the next potential crisis when and as and when it happens. So you have to use good times to rein in. And this is also very good for medium-term earnings. I'll come to that in a moment. But the pace of fiscal consolidation is going to be a lot slower in the subsequent 12 months. Only 40 bips on 4.8 versus 1.2% on 6. So it's halving. And at the same time, and that's why I have termed this budget as a magic budget, the government's capex as a percentage of GDP is going up from 4 to 4.2. And they're achieving this very favorable mix by constraining subsidy spending, which, by the way, in this budget hit near all-time lows. So it's a very sweet budget for the market. The RBI policy is sweet. The market has just ignored this, what I call as policy pivot. You could put the chart up there. The policy uncertainty for India, the uncertainty rose into the end of last year, and then it has had this V-shaped recovery.
From an RBI perspective, you're saying?
From RBI and from government perspective, India's policy environment today is far more certain than the rest of the world put together, whether it's US, Europe, or China. So you want to buy this policy certainty, and I think investors will buy it. Our retail investors get it. And I suspect that February may have been record inflows. And a lot of people have been quizzing me about when will retail give up. And I've got tired of saying this, they won't.
Getting the data tomorrow. And
yeah, you will get the data tomorrow. I won't be surprised if it's a record high or near about there. Retail is not going to give up because this is a shift in the balance sheet allocation that got underway in 2015. Again, because of a major policy shift, and I'm digressing a bit, when the Prime Minister's allowed retirement funds to buy stocks, that is Provident Fund and NPS, which was very similar to what Ronald Reagan had done in 1980, when he allowed 401k plans to buy US stocks. We got a 20-year bull market in America, which ended with the NASDAQ bubble. And it ended because a lot of baby boomers started retiring. And they had to take money out of the markets. Here, nobody's retiring in 20 years. This has got many more legs to go. So the retail bid is persistent. Nigel, you mentioned oil prices are down. That helps. It's not a major game changer for India as it used to be in the past, because the oil intensity of our GDP has halved in the last 5-7 years. Again, due to major structural reforms that the government has taken, electrification of the railways, faster highways, FASTag, GST, I can go on and on. Yeah. But for those who've been long enough in this market will remember that 20 or 25 years ago, one of the quintessential trades in the market was to buy diesel genset companies. Nobody is using diesel to fire up electricity now. Yeah. Electricity is on the grid, and almost every household in India has electricity. So our consumption of oil versus GDP has more than halved in the last few years. So that
sensitivity to oil prices,
sensitivity to oil has broken down, but yeah, I will take 65 on oil. Yeah. And we have the DXY, which was a source of pain. So what you should see is the real effective exchange rate, and the rupee was doing very well in December, even though the headlines would be it's going down, but on a relative basis, it was doing very well. The RBI was defending it. But since then, the rupee has gone down by 6% in real effective terms, and it's now at levels that we have not seen in a while. You have to go back all the way to 2017. So there's a big correction that has happened in the currency markets. The most important thing, and don't look at what equity investors are doing, look at what bond investors are doing. $900 million of inflows 2 weeks ago, last week $2 billion. FPI debt flows have turned like this. Right. They are suggesting that the rupee has now reached a level where they don't expect much more in terms of downdraft. In fact, if anything, probably an appreciation. And I think that is a very important change that has happened.
Okay, all right. Ridham, taking all those points on board, and the last time we spoke, you were talking about this budget being a magic one. Unfortunately for the equity markets, the reaction has been tragic, right? Because the markets didn't really take that in its stride. That said, one of the big reasons is because of the FPI outflows in the equity markets. And that's getting very, very aggressive and excessive, one could say, with their holding at multi-year lows. What's your sense? Earnings are going to return. We have capex spends that's going to pick up. And, the tailwinds in the lower crude price as well. Do you think they're coming back?
Let me try and explain this for the 500th time. There are only two cohorts in the market, domestic investors and foreign investors. You can break domestic down by institution, retail. You can do all those things, HNIs. You can do Lots of breakdowns of those, but we keep it simple, 2 cohorts. Even foreign portfolio flows can be broken down into many categories. Now, every morning, 9:15, this cohort on the right-hand side, which is domestic, is putting its bid in relentlessly.
Yeah.
How can this guy buy? Can't. Because you can't get a trade in the market if there are only buyers. Somebody has to sell. So I've tried to explain this, that the only time foreigners can buy is one of the two happens. Either domestic starts selling, they won't at these levels. You put share prices higher, they will. So foreigners will have to pay a lot more to get in. Or the third player comes in, which is corporate issuers. Because net inflow into the market is what you get in terms of issuances minus buybacks. So that is your net inflow. So if corporate issuances take off, then foreigners can buy those issuances and they can participate. Otherwise, expecting that foreigners will buy without domestic selling ain't happening. It is just not, it's not practically possible.
Right.
Which is what we actually saw for a lot of early, late 23, 24, because that was the block deal buzz, right? Nimesh would come every day, talk about the blocks and the QIPs.
A lot of issuances took
primary
place.
Issuances.
In 24, last quarter, if you look at the issuances on an annualized basis, it was about 2/3 of the previous peak. Yeah. And that was when foreign investors could buy.
Yes.
Yeah.
Once the issuances faded, their ability to outbid domestic is constrained.
Yeah.
You must understand that those who are 8,000 miles away from India understand India a lot less than those who are sitting 1 mile away from the stock market. So this was not the case 10 years ago. 10 years ago, the only buyer in India was foreigners and domestics were persistent sellers.
Yeah.
Retail took its holding in the market down from 27 to 8.
Yeah.
That's how intense, they were so scarred by the scam of the early 90s that a whole generation lost, exited the market. This is very different now.
Yeah.
But Ridham, to come back, actually I'm coming back to the opening question with this. We completely take your point on the fact that how can FPIs buy if there's no seller in the Indian market? That point is well taken. But isn't it true that the last 5 months were also about realizing that India is not the only game in town? There was that US exceptionalism trade playing out, right? It was like the US economy and the US market could do no wrong. It was that tech trade playing out. Like you mentioned, there was China as well. China started grabbing attention as well. So from that standpoint, are we now better placed? Because US seems to have its own issues. China, we don't know. There's a lot of stimulus there, but we don't know. But from that standpoint, when you sort of hear global chatter, is it relatively looking better for India?
So the exhibit to look at, if you can put it up on the screen, is the relative valuations that India has versus the world. Foreign investors, the biggest problem they had was with respect to the price that they were paying, valuations. And India's valuations versus the world were like this. They've collapsed. Yeah. We're now a stone's throw from the bottom hit in COVID relative to the world. So we're very attractively valued.
Okay.
And at the same time, if you look at consensus earnings, and I am more bullish than consensus, I think growth is going to surprise to the upside because of the pivot in the policy. But let's take consensus. I have the consensus estimates for the world, rest of the world, and for India. That has actually made an inflection in the last 2 weeks.
Oh.
Yeah.
Relatively. Okay. Not because Indian earnings estimates have gone up, because world earning estimates are going down faster than India. So on a relative basis, India actually looks much sweeter than it has in many months now. Yeah. This is not just about the last 5 months. India was looking stretched for a long time into this. And foreign investors had cut back. Now, if you look at the foreign portfolio position in India, they are the most underweight they've been on Indian equities ever. I have data for 25 years. And the last time they were underweight was in 2007. And they've been overweight all along, and they've been cutting that overweight position for the last 10 years. They've been net sellers in the last 10 years because domestics have been buying. And now that underweight position has gone down to levels we have never seen. So, yeah, foreign portfolios exposure is low. Indian valuations on a relative basis looks better. Indian growth on a relative basis looks better. Policy is more certain. Yeah. And most importantly, India is now a low beta market. Unlike the past. So if you go back 10, 15 years, India used to be a market which had a beta of more than 1. And for your listeners, that means that India used to go up or down a lot more than the world. Now, if the world is in a trickier position than it has been for many years, the likelihood is that India will outperform. It's a India is like consumer staple stocks. It will outperform a bear market in the world. So it is quite attractive at the moment.
So 12 months down the line, if you put in a level for the Nifty, I mean, you're clearly sounding very, very optimistic with regard to the prospects, all the data that you put on board as well. The FIIs underway, the retail you're not worried about. I'm part of that, and I'm telling you that I'm keeping the money going in there. But, you know, what kind of return should we be looking at on the headline index from here on, post that 15% correction?
So, Nigel, I was chatting with one of our larger mutual fund distributors, and he happened to meet a lot of institutional investors, and he said, you know, these guys are not going to make money in India. And I said, why do you say that? Oh, because their time frame is 1 month to 3 months. He said, my pool of investors, which is the retail guys, they come in, they put the money and go to sleep. So don't ask me for a 1-year view. The thing is that it is very hard to time the bottom. I know Surabhi opened the show by saying, I think it's a bottom. I have no idea whether it's a bottom or not. What I know is that stocks are looking attractive. And in time, this may prove to be you know, a good time to engage. There's a lot of uncertainty around. It's a lot less than the uncertainty we experienced during COVID. But during COVID, one of the things I had read in my life, which was of great use to me, was that the point of maximum uncertainty is also equal to the point of maximum return. So we may not have maxed out on uncertainty. Maybe it gets a bit more uncertain in the next 4 weeks or 5 weeks. But as it gets more uncertain, the point of maximum return is coming in. Now, I'm not trying to avoid your question. The challenge of answering your question is that you have to put it in the context of the world. So I have no idea what the SPX is going to do. I have no idea what China is going to do. I think India will beat these markets.
India will outperform from here.
And I think small and mid caps will do quite well into the next few months. Maybe they go down first a little bit more before they turn around, but it's very hard to catch them.
So India outperforms many emerging markets from here on, and the breadth of the market, the broader markets will outperform from here on.
I think India outperforms the world at large.
Okay.
Including the US markets from here. And I think, yes, mid and maybe from a sectoral perspective, you've not asked me, but financials are doing well right now. I think they'll lead this market out of its problems, and then it will transfer to consumer and industrials and other sectors.
Those are your 3 key overweights as well: financials, consumer discretionary, and industrials. And that SMID call is very interesting. It's an anti-consensus call, right? While the world is saying go buy large caps in India, Ridham is still very, very bullish on the small and mid cap space. Well, we do have
to take... It wasn't last year, and I was wrong because SMIDs continued to outperform. And it took a while for that trade to unravel because SMIDs did look quite rich for most of last year, but they just continued relentlessly and then went into excessive valuation territory. But I think we've come out of that now. Okay,
so SMID's also looking good now. Got that point. Well, we do have to take a very, very quick break. But on the other side, we engage with some of the companies from some of the sectors that Ridham is very, very optimistic on. As market editor, we will get you his interaction with Mr. H.M. Bangur of Shree Cements. Join in for that conversation in just a bit after break.